Let's continue on with that investment strategy thematic. And our next guest says the world is on life support with record debt levels, central bankers that continue to deal with the situation by injecting liquidity into the system. And so the question always is, what does that mean for the way that you allocate capital? Rob Shears, Principal Advisor and Director at Valor Private Wealth, is joining us live in studio. Welcome.
Thank you very much.
Is it an equity story? I mean, while we've got this liquidity, while we've got this momentum, you've just got to be invested.
I think it's a difficult story no matter what you do. In a world of zero interest rates, there's a lot of things which just won't work over the next 10 years in terms of what has worked for the last 100 years. Everything's expensive. It's the everything bubble. The issue is that with the debt levels we have and with the central bank strategies, we may have a Japan-style scenario, and we may have a Japanification of the world where we have zero interest rates for 32 years. And that's not good for retirees.
It's not good for retirees. No. Does push equity prices higher though?
Well, equity prices are already high, so they may go higher, no one knows. I think that the levels that the equity markets are at traditionally, if you look back for the last 100 years, it suggests that there's going to be fairly anemic returns at best for the next decade. So that's probably not much upside if you're doing what most people are doing.
So where are you putting your money then?
I think that, ironically, as much as the equity markets have gone to these extraordinary levels, there's a subsector of the world's best businesses which haven't really rallied as much as their earnings have actually rallied. So we own some of the world's best businesses, and a lot of them have gone down in the last 6 months while the markets have rallied. So not everything's expensive.
What are the world's best businesses then, in your view?
The big, boring, safe companies. So the big, boring, safe companies, I was talking about the other day about the cloud companies. They're actually not expensive. So Amazon, Microsoft, and Google. That's basically the railways of today for the cloud. It's pretty much most of the cloud infrastructure is those three companies, mainly Amazon and Microsoft. Mm-hmm. And they're accelerating in the last year or so. And a lot of that's brought on by COVID, but I think it's actually, its future acceleration is sort of baked in, because as these cloud components of the business gets a larger part of the business, they're growing much faster than the rest of the business. And so if you look at Microsoft, for example, Microsoft's grown at 8.5% for the last decade, and recently they're growing now at 17%. Their revenues are growing 17% as Azure becomes a bigger part of Microsoft, and Azure is growing 50% per annum. Mm-hmm. So Microsoft's accelerating, and these are $1.8 trillion companies, and they're growing faster than they were for the last decade.
And Amazon is an AWS story then, correct, no doubt. Would you be comfortable buying these companies at these levels? I think you answered that question already. In the future, considering we're in this environment, do you anticipate we'll see the splitting of some of these big companies? And as an investor, do you want to see that? Do you want to see Amazon retail on one side, Amazon AWS on another?
It could happen. I think that if you look at the way Andy Jassy, who's now the new CEO of Amazon, describes it, they sort of talk about verticals. They're a big company, but on the individual verticals, they're certainly not the only game in town. They talk about in retail, they're a minnow on global retail. So in cloud infrastructure, yes, they're the largest, but it's not zero competition. Azure is actually growing faster. Yes, they could be broken up. They have done things which I don't necessarily think are not under the radar. They're not under the radar, certainly. Mm-hmm. I think Microsoft may be under the radar. They're not in the sights of the breakup crew. So Microsoft has, from their 20 years ago issues, have sort of come through this period almost unscathed. So Microsoft seems to be much lower regulatory risk than the others. Mm-hmm.
What about when it comes to non-US stories, when it comes to tech, maybe like the next tier down? Do you like companies like Xero?
Love Xero. I think it's probably one of the best businesses to come out of New Zealand ever. It just is a fantastic business. So they've grown rapidly. In the last 8 years, I think they've gone from 31 million to 760 million in revenues. So it's a very, very fast growing business. We were late to the party. This has been an obvious story for a number of years. They dominated Australia and New Zealand. Basically, the way they work is they're a cloud infrastructure accounting company. Once they get the accountants on board, they get a network effect, and everyone wants to join the party because everyone else is in the party. So once the accountants are using the one piece of software, they don't want to use multiple pieces of software. And once the users realise they can get payroll and everything all automated, superannuation systems all automated, they all want to be on the same system. So it creates a flywheel. That pretty much destroyed all their competitors in Australia, but they're doing the same thing now in the UK. It seems like they're winning the UK, which is a much larger market.
So those charts on screen right now don't scare you, buying Xero at this level, because you see it as a very long story.
Yeah, we bought it a bit lower than this level, but I think that if they continue winning in the UK, and it's basically Xero and Intuit are the leaders in this space, and I think that over the next 20 years, it's going to be a two-horse race, and it's almost a winner takes all in the markets, because once you get in that market, you get all the local apps, the local payroll software, the local taxation, and that flywheel spins, and it's very hard to break into that market. So I think they're going to go country for country, Intuit, Xero. They probably won't be 50-50 in each country, it'll be 80-20 in each country. And I think Xero's going to have a very difficult time going to the US, because Intuit is just so dominant there.
What else is on your list? Anything rogue? I can see one here that you've sent over, Ambev.
Yes.
This is a beer company.
Correct, yeah, so Corona beer, not the coronavirus.
Yeah, that's a relief.
So Ambev is probably the world's best beer company. It's basically the mini Budweiser for South America and for Canada. So it's Budweiser for commodity countries. Now, if you think about the monetary stimulus, the Japanification of the world, what's happening is that's causing commodity prices to rocket up. You look at the copper price, the iron ore price, everything, all the commodity prices are shooting up. That is very good for commodity countries. So we think that Ambev has triple tailwinds. They've got, obviously the currencies will likely get stronger in a rising commodity price environment for these countries. So we're talking Chile and Brazil and all these other countries, Canada. And so as the currency rises, that's very good for Ambev, which is listed in New York. The second one is that obviously employment picks up and wage growth picks up. You look at Perth housing prices and what happened in Perth during the mining boom, but it gets very buoyant. So in these commodity countries, people drink more beer. People were drinking more beer in 2011 in Perth than they were in normal times. So these countries, they'll drink more beer, but then there's also premiumisation. So people move up the beer category. People probably went from VB to Corona beer in Perth in 2011. So we think that's going to happen in South America as well. The triple tailwinds: currency, higher volumes, and premiumisation, and that's very, very good. If you look at after at the peak of the last mining boom, Ambev got to, and it took a year before it sort of took a leg down. Ambev got to $9.28, I think it is, and we bought it at $2.20 recently, but it's only $2.80 at the moment. So we think there's a long way to run on this story if there is a commodity boom.
Ambev, and it's listed in New York.
Listed in New York, yes.
Great.
Yeah.
That was all really interesting. Rob Shears, thank you so much for joining us. Really appreciate it.
Thank you very much for having me. Thank you. Thanks.
From Valor Private Wealth.